Right, thank you very much for turning up. For those that don't know me, I'm Ben Ashby. I'm the Chief Investment Officer for Henderson Rowe, and I also manage the bond side of things, income side of things for Rayliant, our parent company. And continuing with our theme, I've got the latest 1970s song title for you. So the whole principle behind this one, just explaining that we are moving from one regime to another. And I'm going to kind of explain what they're going to do financially, what it means for your investments, and actually what it means politically. So I was going to talk that through. We're moving to Zion. Why are we moving there? What this means for your investments, what history tells us is likely to happen next. For those that don't know, I sit on the board of Cambridge University, not the board, a board, and we cover economic and financial history. So I've asked my fellow colleagues there and the academics about what would be normally expected to happen next when you get these kind of economic conditions. And then finally, what we're doing about it. So we always start off with a bit of a brain teaser. So can you join all 9 dots using just 4 straight lines? I'll give you the answer. It's, as usual, a trick. There you are. Everybody automatically gravitates to thinking, how do I join those dots, without actually just thinking about, you don't have to be inside the box. At no point did I ask you to do that. So the whole key point is thinking outside the grid, thinking outside the box. And why have I done that? Because which of these, and you all know this is going to be a trick question, which of these is worth the most? It's the £2 coin. Why is the £2 coin worth more? Because it's actually got, it's got real commodity in there. Everything else, that's paper, they're smaller, there's less of them. So I've got the next question for you, for the people in the room that can remember this. Between the £2 coin and the old 50p coin, which do you think is worth more? It's the old 50p coin. So we all know, like, the 2p coin has been degraded, the 50p coin has been degraded. Why are they doing that? Because the value of the actual materials in there keep going up, and it's not economic for them to do it. And the whole point that I'm trying to get to, that ordinarily, if I offered you a £50 note, that's the one you would take, but it has no intrinsic value other than the intrinsic value that you put to it. And the problem that we have with that is, over the next couple of years, the government is going to start devaluing its debts. Now, only 5% of the currency in the country is actually in physical form. 95% of it is actually just electronic. So you don't even get to this level of valuation on the thing. It's just been literally made up on computers. And the other thing that everybody forgets about currency and money is it is government debt. And in many ways, it's the cheapest form of government debt because it's the easiest stuff to print. And that's basically what we're going to see over the next few years. The government understands, well, Rachel Reeves might not, but she's got a vague idea, what the value of debt is. So just a quick recap, the economy keeps getting slower and slower and slower. Unfortunately, with the government expenditure, so as we know, the government keeps borrowing money. There was even more numbers this morning where there's even higher levels of borrowing going through. They keep charging more tax. And one of the fundamental problems that we've got is the current government, and this is not a political statement per se, just doesn't have a growth mindset. The easiest thing to get the economy going is to generate growth. Unfortunately, that's not how they look at things. So they're trying to raise more taxes to pay for stuff. Why is the economy grinding to a halt? This is all you really need to know. The public sector hasn't grown for ages. There's no productivity growth. What has been growing is the private sector. All the people working here today, or mainly what you guys have done previously in your jobs or businesses. But she keeps extracting tax out of the private sector to basically pump up the public sector. And it's not going anywhere. You know, it's resisted the internet. It's almost certainly going to resist AI and various other things. And we could see that with the latest numbers. So since she got into power, the private sector has shed about 150,000 jobs. And the state sector has created 75,000 jobs, if that's the right way of looking at things. Obviously, this is unsustainable. And the other issue you've got as well is she's been borrowing money because she can't get enough tax out of the economy, and every time she takes money out of the private sector and dumps it into the public sector, it slows down more. That's why the 9 billion the OBR originally said in terms of a hole in the balance sheet suddenly magically became 22. She then took 40 billion, and now she's coming back for another 20 because the debts keep getting bigger quicker the cost of borrowing keeps going up, partly because it's going up, partly because you're borrowing more money, and yet you're extracting it out the side of the economy that actually delivers most of the goods. So what's the next option that she's got? She's going to devalue the currency. And that's why I wanted to start off with money and explaining it is government debt. Now, allegedly, the Bank of England is meant to give you confidence in terms of that they're not going to do this. But the blue line at the bottom there at 2% is the Bank of England target. Now, the government uses two measures of inflation, depending whether you owe it money or it thinks it owes you money. Broadly, CPI, which I won't go through the details, is what it tries to use. But you can see it rarely hits that target. And the point I'm making on the right-hand side is things soon start to build up. So over time, all this stuff gets devalued. Over time, the real value of those goods gets devalued because money is just something you accept for a period of time. You're prepared to accept it because you live in a country that makes usually a half-assed effort to try and keep it with some value. If you go and move somewhere else like Venezuela or Argentina, they generally make no effort, which is why the currency isn't generally very strong. But there's another measure of inflation, which is RPI, which oddly enough the government doesn't like to focus on, unless you owe it money. So anybody that's got kids at university at the moment will absolutely know what RPI is, because that's what they charge them on student loans. So they can't even manage to keep it to their own level, which they rig. If you want to know the big difference between the two, one includes housing costs and the other one largely doesn't. So if you're homeless, you know, or you don't own any property whatsoever, CPI is a fairly decent measure. For a lot of other people in the country, it isn't. And if you're a student that owns nothing in terms of housing, and they're charging you loans on the top of that, and yet they've slowed the economy down, you're really getting a bad deal. And that kind of goes to the next point I'd kind of make, that this will build up socially. You're beginning to see it. Everything, as I've sort of pointed out over the last 2 years, you're beginning to recreate the problems of the 1970s, hence the dodgy song titles, hence the growing political instability, hence the growing populism. And you know they're going to do it because, again, CPI, that's the measure they're meant to be doing, and they're meant to be managing it to 2%. You can see is roughly running just under 4% at the moment, so double what they told you they would manage it to. RPI is running even higher. The blue line is what the government is borrowing money at. So if you buy government debt, which I believe is the only asset I'm allowed to say, my compliance officer is here, is government debt risk-free? Am I legally allowed to say, is government debt risk-free? So the government tells me that lending money to them is risk-free, but I can absolutely show you as an ex-banker, you're going to lose money. You just need to work out how quickly that rate of loss is. So at the moment, because everybody thinks interest rates are going to be cut, what the government can borrow at on a 2-year view is actually below. So you have to pretty much guess and be sure that inflation's coming down. Beyond that point, as you can see, the cost of government borrowing, it's only when you start to get to around 8 years does it start to match CPI. And if you're in an RPI world, God forbid you have a property, or you might be student or something else like that, I don't know, mobile phone is another thing, or travelling on the train, lots of them are linked to RPI. You don't actually get a positive return on your money buying it today unless you're lending the government for 30 years. And these are a bunch of guys that haven't hit their inflation targets pretty much since the day the Bank of England started, and they have very little intention of doing it going forward. So the point I just wanted to explain is money isn't as safe as what you think it is. So what can you do about it? This is the other thing I just wanted to show you how government debt looks like. So even on their own terms, if you had bought the standard government bond fund in the UK, you've lost nearly 30% of your money over the last few years. And you can see it's flatlining. And you know why it's flatlining, because look at the last chart. It's not keeping up with inflation. So that's why there's no real appreciation in the thing. It's standing still. If you're Swiss, you're even more pissed off, because effectively if you'd basically been a Swiss investor and decided that actually the Bank of England was a decent investment, you've lost, as you can see there, nearly 40% of your money. But if we bank back to the old world, and I'm not a gold bug, but one of the things we used to have was gold to hold governments in order. And if you were in the government world, or in the gold world, you can see that basically 60% of your money has been eroded in value. So everybody knows that in the portfolio that we've been managing, we've been adding gold over the last year or so. We've been adding gold mining shares. One of the reasons why they're going up is because in that world, everybody can see that the currencies are being debased. whether it's America, whether it's Europe, whether it's China, who is actually the worst currency debaser at the moment, which is one of the reasons why you're seeing even more gold purchasing going on, as well as the politics around the US and China. So the point I'm trying to make, that things that people think are safe, money and government debt, because the government tells me it's risk-free, unless I happen to want to live a life, are almost certainly going to go down. So what does this mean? So you've got a government that's raising taxes, there's no economic growth, it's a bit of a rip-off for the younger generation, they can't afford to buy a house, they've got saddled with student debts. Well, actually, we've got a lot of history, as I mentioned earlier on, about what this generally means for people. So society tends to see economic stagnation. Yep, we got that one. Capital drain. As you know, a bunch of people, in fact, I believe some people in this room are thinking about leaving. Social unrest and erosion of public trust. Yep, got that already. And increased inequality. That's the one that usually confuses people about, well, why is this happening? It's because one half of the country doesn't actually own any assets and bearing most of the cost of the inflation. And the other half of the country who do own assets actually benefit, at least in nominal terms, from some kind of asset price inflation. And actually a better example of what's going on at the moment is the United States, where people that have been here before I thought they were going to be serious about sorting the currency out in 22 and 23. They didn't. They basically carried on printing money, kept the stock market up. Great for that small collection of people, but unfortunately in a democracy you need to worry about the people that vote. And that's what cost Biden the election. Trump's made the same mistake. So you look at his polling at the moment, it's absolutely collapsing with the bottom parts of the voter groups because the cost of living is going through a roof. Why is that? Because they're spending 7% more every year than they're taking in terms of taxes, and you've decided to put tariffs on everybody. So slowly but surely, you are building up a head of steam on inflation. You are definitely debasing the currency. Politics, political instability, got that. You can see collapse of the old parties happening all across Europe, rise of populism. People still blame everything on Farage and Trump. The key thing is, as I've said before, they are symptoms, they are not causes. These people turn up frequently at the end of long economic cycles when you get political instability. Fiscal crisis, we haven't hit that point, but watch this space, particularly with this government. Increased authoritarianism, so when we record this, it'll be heavily edited, so I don't end up going to jail. Alternative funding, so there's a good chance we're going to get mansion taxes and various other things. So one way or the other, they're beginning to look at unusual ways, whether it's an exit tax or stuff like that, to try and raise government money. So what can you do about it? Increased international diversification, invest in hard assets. So even though if they might not go up in real term, but things like property tends to keep to a certain level, at least with the inflation, and various other inflation-resistant investments, which is actually what you pay us for. So fortunately, I have got some solutions for you. But before I go into them, I just want to take the next slide. One of the key things here is this. I've taken US data because it's a bit more consistent over time, and historically they had a longer period of an independent central bank. But you can see broadly, if you will hold US stocks over time, they will generally beat inflation the longer you hold. Not necessarily in the short term, and there's stock market crashes and there's reversals and there's various other things. But the key thing with cash, even in the US, which, like I said, has had an independent central bank, unlike the Bank of England, which has only been actually independent since '92, at best, over 20 years, so that's periods of inflation, deflation, or whatever, 65% of the time your cash might beat inflation. The shorter the time frame, the less likely it's going to happen. And I would say in the current regime where we are at the moment, this move into Zion, it's less likely to happen. Now, the second one is from Schroders, who people tell me is a competitor of ours, but probably much smaller and more obscure. But Schroders did some work for you that most of you hold too much cash. So just think that I appreciate it feels safe, but it is eroding in effectively 4% every year at the moment, and maybe more depending on your lifestyle. If you'd actually put some of that cash into the stock market and dealt with the volatility, because it's not a free trade, you would be materially much richer for it. And that's kind of the point I'm making, that you need to think about assets that are going to do well in an inflationary environment, but unfortunately you're going to have to accept that they will move around a bit more than cash. You've got the certainty of cash, it looks safe, doesn't change it month after month, but in real terms it's coming down. But then you get into the next problem. What is international diversification? Now, rumour catches my ear that some of you also use competitor services, which I can't believe it's true, but just say, theoretically, that some of you did. Theoretically, some of you have given you a diversified international portfolio. Most of our competitors hang around benchmarks. The benchmark is roughly, at the moment, 65% US stocks. That is your diversification, 65%, and that's everything in the world if you took that. If you took just developed nations, you're up to about 70-75% on some of the indices. Which gets you to the next point. If you have gone out and basically, without checking what's in that portfolio, you've taken an enormous bet on US technology stocks. That is a huge percentage of the index. So the US is the biggest component by far, and of that component, most of it, or sorry, a big chunk of it is US stocks, and that's just the tech stocks. If you're worried about AI, which increasingly the FT seems to be and various other individuals, you look in there, there's actually even more stuff in there because there's a load of commercial property companies that have also been busy building out data centers. So you add them in and you've got another 5 to 10 points of US technology exposure on the index. So the point I'm just making, international diversification is good. For most parts, mindlessly doing international diversification might not be the kind of thing that you think it is. So should you know somebody that's working with somebody else, you need to have a think about what's in there. You need to point out to them that actually what have they done with your money. Now, it may do very well over the next year. It's done very well over the last 10 years. It may do very well over the next 2 or 3 years. But if history is any guide, statistically, the chance of making a return when you're paying up for those stocks at the levels they're being priced at the moment with that component is 0 over the next 10 years. So that brings you back to the earlier chart, which we won't go back to, and happily make the slides available, and as you know, we record it. But you are unlikely to do very well paying for things at that price at the moment. So this is what you need to think about. So it's a takeaway. I know you pay us to do this, so you know I'm just explaining what I do for you. But it's been very good over the last 10, 15 years to just own the index. And it's done so well that 60% of all investors in the market now mindlessly own the index. These things didn't care about the price they were paying on the way up, which is now why we've got one of history's all-time valuation bubbles. And I can absolutely guarantee you they won't care about the price when they have to sell on the way down. The single most important decision you can make over the next couple of years is asset allocation. You can still own passive, you know, you can still maybe work with other fund managers for whatever reason you decide, but you need to be really certain about what's in that portfolio and have they genuinely given you diversity, because that's not what's happening at the moment, and that's what's partly fueling the bubble. And as many of you know, I used to work for a large US bank. Let's call it D.H. Evans for the sake of copyright reasons. You see this all the time. They print money, it has to go somewhere. It goes in, it pushes up property prices, it pushes up the price of phone contracts, it pushes up the price of stocks. And that's one of the reasons why you haven't really had to think about stuff over the last 10, 15 years. But you are going to have to think about it, because once you get to rising rate environments, which is the whole point of the Zion talk, inflation is coming back. We can see it, it's not going away. And in the US, which is again 65% of most of the investments, it's likely to start accelerating again because they're doing everything, pretty much everything, that would give you inflation. You have to think where passive doesn't do well, so you don't want to be in the crowd. So again, small cap, emerging markets, small cap, small companies, smaller, medium-sized businesses, where everybody isn't crowded in, where the valuation isn't extreme. Certain parts of the corporate credit market, so that's lending debt to good quality companies on a relatively short date. You don't want to be in the same position as lending money to the government for 30 years. Again, when you get major regime shifts, sector rotations, which is broadly what you're beginning to see now. The politics don't work, the economics don't work, that drives the politics. The politics will drive markets. That's why you get people voted in. That's why there's almost certainly going to be quite a sea change in British politics over the next 3-4 years. Though the biggest sea change would be getting somebody competent in. I'm not sure we're going to break that trend over the last few decades. But also there's a reasonable chance the markets will start to get very worried about how governments are going to pay their debts back. And you can already see that discussion coming through here. It's happening in the States. You need to think about putting yourself in those areas. Unfortunately, that's kind of what some of our stuff does. So, you know, the GQE portfolio is globally diversified. It doesn't have a lot of those tech companies in there. It has a whole range of businesses in there. We select them on completely different methodology. It might not always outperform. It's obviously done relatively well for the last few years, but it's one of the things that we thought long and hard about when we put stuff in there. One of the reasons we gave you the international diversification, again, away from those indices. We don't track it. You can buy that anywhere else. But again, we're thinking long and hard about that shift as it's coming through. And yeah, we look, very patiently what's going to happen. The other thing that we do as well is we know they're going to devalue government debt. So one of the things we have is, that's what the Nebworth fund's called an income fund. So we have a bunch of investments in there. Some of it's short-dated corporate debt. Some of it's slightly longer-dated stuff, but it's linked to RPI-linked contracts. So even for the UK payout, you've actually got something that's linked there, at least for the time being. Who knows with government changes, but you've got a legally binding contract that if it goes up by RPI, you're going to get paid for it. So we've tried to blend all those things through and put a little bit of protection insurance over the top so it doesn't move around so much, because unfortunately that will be one of the trade-offs. As the market starts to work out what's going on, as it starts to worry about will debt get paid back, the market will move around a lot. Largely we've tried to avoid that stuff, but nothing will be perfect, but we've bought insurance to pay up. So that's last slide you'll be glad to see. History's likely to repeat itself, consistent across different countries, different times. Debt and money is going to be devalued, but particularly government debt. The longer you lend the government money, the more it's going to find a way to devalue that debt for you, whether it's through the currency or just actually some other means of payment where they just decide they're not going to pay that, which they already did in the debt markets. They moved away from RPI a few years ago and started paying up CPI, weirdly. Diversify, don't panic, it's going to get a little bit volatile at times. Focus on income, we've done that for you, and consider moving abroad. It really does work. That is one of the most consistent things you can do to avoid it, is just watch the car crash from your villa in Switzerland and think, I'm so glad I didn't hang around for that. So doing a Roger Moore in the modern thing. So yeah, that's why Michael Caine, Roger Moore, and a whole host of other people disappeared in the 1970s. They weren't going to pay the tax, and they happily sat abroad and watched everything play out. That's all for me. Thank you very much.